Hello and welcome back to the channel with Dividend Talk. Smash that like button and let's jump straight in the battle of Coke versus Pepsi. Today we will be looking at the Coca-Cola company, ticker symbol KO. We're going to take a quick look at the graphs here. We're going to look at the balance sheet. We're going to look at the dividend safety of Coca-Cola. We're going to run it through our stock valuation system and see whether or not we have an acceptable buy price within our margin of safety. So let's jump straight in. So as you can see over the 10-year graph, Coke has grown 49%. Now, personally, I like to see double digits in terms of I like to see 100% plus. So for me, this isn't the great start in terms of looking at that trajectory over the last 10 years. However, a lot of people will say that Coke is a stable company. The yield is around 3%, just slightly shy, and just slightly shy of 275 billion in terms of the market cap. We'll also look at the 52-week range shortly. If we just have a quick look at the year-to-date with the Coca-Cola company, we can see it's remained relatively flat. Now, one thing I just want to make people aware of, if we just take a very quick look at the balance sheet, the cash and cash equivalents of Coca-Cola company has remained relatively flat, 9 billion in December 2018 and just slightly above that in the latest report in December 22. However, one thing that is interesting to note is if we just very quickly scroll down to the long-term debt of the company, we can see here in December 18 it was 25 billion. And the latest report in December 22 is nearly 50% larger with 38 billion. So one thing just to keep in mind, again, don't look at any of this in isolation. If we just have a very quick look at the different brands within Coca-Cola, you have Costa Coffee, which not many people are aware of. You have your Fanta, your Sprites, you have your Minute Maid, Innocent, and a few others. We can run into Pepsi's in tomorrow's episode. If we now take a look at the dividend safety, a score of 80, which means it's safe, we want to take a look at the growth and the yield in the next few slides. So as we can see with Coca-Cola, their dividend growth hasn't been the greatest, around 4.5% in February of this year, with the last 20 years around 8%, which is probably nicer to see. The reason why 4.5% isn't the greatest, in my personal opinion, is because the inflation rate over the last 30 years in the US has been around 4%. So that is effectively just keeping up with the inflation. Two great things I like to hear here at the bottom. They've increased their dividends for 60 years, which makes them a dividend king, and they have been paying dividends for 103 years, which is great to see. Now, dividend yield theory essentially says when the dividend yield is above the 5-year average, that the stock is undervalued. As we can see here, it's slightly below the 5-year average at 3.09%. So in my opinion, just based off this, you could say that it is reasonably valued. However, again, let's not take things in isolation and let's get a holistic view at the end. The forward PE is essentially in line with the 5-year average of 24.2. If we look at the sector comparison, we'll take a look a bit more when we look at our multiples valuation. Coca-Cola is trading at 24.4 with the sector at 22.1. One thing we can see here is the 52-week price range of Coca-Cola is headed towards that 52-week high of 66.21. Again, you can't really take any of this in isolation, but I personally prefer to buy stocks that are leaning more towards the 52-week low. Jumping on to the earnings payout ratio, as always, I prefer to look at the free cash flow payout ratio as it's one of my 7 golden dividend metrics. You can watch one of those videos there where I explain my 7 metrics. Very quickly though, the earnings payout I like to see below 60%, maybe 70 to 80% for a mature company like Coca-Cola. So in my opinion, these figures here of 70% aren't that bad. If we look at the free cash flow payout ratio, from 2019 onwards, it's around that 80%. Again, not the best, but also not the worst. I personally prefer around 60% and lower, just so that there's room for that dividend to keep on growing. Now, if we look at the sales growth, we can see that essentially from 2013 to 2020, there was a lot of negative growth. However, that has picked up in 2021 and 22. So for me, this is a bit of a negative, but we need to understand more before we can conclude. Again, looking at the total sales trajectory from 2013, there is a slight dip inwards and then it picks up from 2020. Not something that you like to see. However, this is a more mature stock, so you wouldn't expect the large increases in revenue that you would in other stocks. Shares outstanding, again, we prefer when companies are buying back shares, as this then returns excess cash to shareholders. However, I would say for the last 10 years it has remained relatively flat. Moving on to the ROIC, return on invested capital, again another one of my golden dividend metrics. I like to see above 10%, and again here over the last 10 years it has been above that 10%, around 17% in 2022 and 16% in 2021, so that's a green tick. Operating margin over 16% for consumer staples and 7% for consumer staples with the free cash flow margin. I would say it's 2 ticks for both of these metrics, so that is a positive for the Coca-Cola company. Net debt to earnings before interest, tax, depreciation and amortization below 4 is what we like to see. I personally like to see below 3, as I'm a bit more on the conservative side and like to have a bit more of a margin of safety, and it is well below 3 all across the last 10 years, so that is a tick. Net debt to capital, so the percentage of financing from debt as opposed to equity, 0.54 essentially means 54% of the company's finance is from debt. I like to see around 0.5 and below, and if we take a look here, it's essentially roughly in line, slightly above. Nothing in my opinion to worry about. However, as I did run through the balance sheet earlier, it is one to be wary given that they have increased that long-term debt significantly over the last 5 years. So please do take that and bear that in mind. Now for the fun part, we want to see what the valuation of the Coca-Cola company is and what we believe the buy price to be. Now Graham's valuation, earnings per share times 7, which is the PE of a company with no growth, plus 1 times our growth rate projection, times 4.4 average yield of a AAA corporate bond, divided by Y, which is essentially the current yield on AAA corporate bonds. So we've inputted our stock, we've inputted our EPS, and we have a growth rate which is in line with analyst estimates at around 8. Although analysts did say 7, however, I've added that slightly more optimistic at around 8 based on their past performance. Now, this gives us a value of 37.6. Now, obviously, that is significantly lower than the current trading price. So I guess let's move on and we'll come back and I'll mention this later on. Now, the multiples valuation model is essentially looking at companies in the similar industry as Coca-Cola, getting to our average PE multiple and multiplying it by the earnings per share. So we take our 2 companies, which I believe to be similar. We have PepsiCo and Monster Beverage. We input our stock price, earnings per share, and we arrive at our PE multiple. So we multiply the average PE to the earnings per share and we get 56.95, again slightly below the current trading price. Moving on to our dividend discount model, we have the last 5 years dividend payout. We then want to multiply the most recent by the growth rate over the constant cost of equity less the growth rate. So as we can see here, Coke has been increasing their dividends on an average of 3.36. I've gone slightly above that. I wouldn't say it's a lot more optimistic, but I've gone slightly above that, given that I think they will continue to raise their dividends more than that 3.36 average. So this gives us a DDM price of $38.27, again significantly under the current stock market price. Now, the discounted cash flow model, we input our free cash flows over the last 10 years. We get to the growth rate per year and an average growth rate of 4%. Now, I've inputted here 8% as I've gone a bit more to what the analysts have said on a forward-looking basis rather than a historic basis, but it is good to see just so that you are aware. Again, we then get from this our future free cash flows and our terminal value, and then we essentially are calculating the present value of these future free cash flows. We add them together, we add our cash and cash equivalents, subtract our debt, and we arrive at our equity value. We then divide this by the shares outstanding to get a DCF price of $44.45. Now, what we have here is our 4 valuation models that we've just run through. And for our average of these, we get the intrinsic value for Coke. Now, this is $44.21. Now, me personally, given that Coke is a more mature company, I don't believe it right to use Graham's valuation model. So I will be removing this. However, I've put this here just so that you are aware. And then if we just update our formula, this gives us an intrinsic value of $46.56. Now, obviously the current price is around $63, so it's significantly higher than what we believe the intrinsic value to be. So just to make you aware, if you had a margin of safety of 10%, you'd be looking at $41.90. However, with Coke, it is important to understand that Coke never really trades around its intrinsic value, and over the last 10 years when I've been looking at this graph, it tends to be trading at a premium with other companies that we have analyzed in the past, such as Costco. So do be wary of that. However, if we just take a look at what Wall Street forecast the price to be over the next 12 months, we can see even on its current price, they are expecting around a 10% uplift. So just to conclude on this, Pepsi versus Coke. With regards to Coke, I personally will not be buying at this price. I understand that even with a margin of safety, it'd be $42, but I would be looking at around slightly above the intrinsic value in the low 50s. So for me, Coke is not a buy. However, please do put in the comments, do you hold Coke? Are you looking to add to your position? And what are your thoughts? And then in tomorrow's episode, we will take a deep dive look at Pepsi. Thank you and have a lovely day.